You've probably heard of stocks and shares before. In this lesson, we're going to discuss stocks and stock prices. We'll also clarify the meaning of some of the words you'll hear when discussing them. Shares of stock represent fractional ownership in a company. If you own one share of a company's stock, and the stock has been split into 8 shares in total, or 8 shares outstanding, you own 1/8 of the company. These days, however, companies split their stock into millions or even billions of shares. Facebook, for example, has issued just under 3 billion shares, while Alphabet, the company that owns Google, has issued about 700 million shares. But what does it really mean to own part of a company as a shareholder? Can you take the company car out for a spin? Not usually. There are actually 2 types of stock, common and preferred stock. Shareholders who own common stock usually get a portion of the company's profits in the form of dividends, if the company distributes them. A dividend is a payment made by a corporation to its investors, usually as a distribution of profits. Shareholders also get the right to vote on matters like who should be on the company's board of directors. If a company is liquidated due to bankruptcy, they also get a portion of the remaining assets after all other stakeholders are compensated. Generally, ownership of shares in publicly traded companies, companies whose stock is owned and traded by the general public, entails what's called limited liability. In part, limited liability means that shareholders cannot be made to pay the company's debts if it goes bankrupt. Shareholders who own preferred stock get a slightly different deal. They are promised a fixed amount of income each year and get paid before owners of common stock get paid dividends, but they usually do not have voting rights. But, of course, one of the main benefits of owning stock is the potential opportunity to profit from selling it after its value has increased. These increases in value are called capital gains. Let's take a moment to clarify the meaning of some words you might hear when discussing stock. A security is a financial instrument that has some type of monetary value. Some securities that you might have heard of are stocks, bonds, and options. Securities can be classified into 3 broad types: debt securities, derivative securities, and equity securities. Debt securities represent money that is owed and must be repaid, like government or corporate bonds or certificates of deposit. Debt securities are also called fixed income securities because they promise a stream of income over time in the form of interest, either at a fixed rate or at a rate determined by a specific formula. Derivative securities, such as options or futures contracts, are so named because their values depend on the prices of other assets. For example, an option is a contract which gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on a specified date. An example of an option contract would be employee stock options. As part of employee incentive programs, employers frequently offer employees the option to buy company stock at a lower price, called the strike price, and later sell it on the open market to make a profit. On the other hand, a futures contract obligates the buyer to buy, or the seller to sell, an asset at a predetermined price at a specified time in the future. For example, say a dairy farmer can currently sell milk for $2 a gallon. Next month, he plans to sell 200 gallons of milk, but he's concerned that fluctuations in the market price for milk will erode his profits. So he enters into a futures contract with an investor. By doing so, he is obligated to sell 200 gallons of milk on the agreed date, but is guaranteed to receive $400, regardless of the market price of milk at that time. This type of agreement would protect him from the risk of catastrophic loss if the price of milk tanks, but will also limit his ability to profit if the price of milk rises. Then there's that last category, equity securities. Let's break that phrase down. Equity is the value of an owned asset minus the amount of all debts or liabilities on that asset. So if you own a $15,000 car, but you owe a $5,000 loan against it, the car represents $10,000 of equity. The word equity can have somewhat different meanings in different contexts, but in general, you can think of equity as the net value of something owned. Stocks are called equity securities because they represent ownership in a firm. One more thing, a security representing ownership interest in a private company is called private equity. So, say you want a chance to reap the potential financial rewards of investment in stock. Where do you start? Well, a brokerage company functions as a middleman connecting buyers and sellers. However, they usually charge fees to complete transactions. It's also sometimes possible to buy stock directly from companies. In this case, you don't have to use or pay commissions to a broker, but you have less control over the price and timing of your purchase. You can't buy or sell at a specific market price or at a specific time. Typically, the company buys or sells shares for the plan at set times and at an average market price. But how the shares are purchased depends on the company and the details of the plan. Once you've bought some stock, you'll be very interested in the patterns of changes in its price, because in order to make money from your investment, you want to sell it when its price is higher than when you bought it. A great deal of effort has gone into predicting when the price of a stock will go up. In order to follow your stock, you'll look up its unique symbol or ticker. Alphabet's unique symbol is GOOG. Apple's ticker is AAPL. This is a price graph of Alphabet stock from 2005 until September 2017. While the graph seems to progress upwards, it isn't a steady or linear climb. The history of a stock's price is important and potentially an indicator of how the stock will do in the future. As such, price histories have been studied by investors and traders since stocks were first traded. But when was that? How did all this get started in the first place? Some people trace the history of stock back to the Roman Republic, when the state contracted out many of its services to private companies, which issued shares to individuals to help with government services. In the early 1600s, the Dutch became the first company in history to issue bonds and shares of stock to the general public. The company established the Amsterdam Stock Exchange in 1602 as a forum for trade of its securities. The Amsterdam Stock Exchange, pictured here, could be called the first incarnation of a modern stock market. Patterns in market activity have been studied since markets' earliest days, and some patterns have been observed to repeat. One of the most interesting market phenomena is the market bubble. Bubbles occur when market participants drive stock prices above their value in relation to some system of valuation. There are notable similarities between the tulip bulb bubble, which took place 4 centuries ago and saw the value of a single tulip bulb grow to nearly 10 times the annual wage of a skilled worker, and the dot-com bubble, which occurred in the early 2000s. The similarities in the graphs are fascinating, and academics, from behavioral economists to theoretical mathematicians, have devised captivating theories as to why bubbles might happen.
This lesson will introduce you to the mechanics behind modern-day stock markets. But not only that, you'll also build a simple market simulator that matches and executes orders and sets prices, just like a real market. This will give you a better idea of all the activities that keep a market running. These activities generate a lot of data, market data, which may hold important clues that you can use to decide when to buy or sell stocks. As you get introduced to the various dimensions of data available to us, try to build an intuition for why they might be important, what signals they might carry. Finally, you'll learn to deal with data during the closing and opening of global markets. Stock markets function in a very similar way. When a company first begins trading publicly, it typically picks a value for its stock based on certain company metrics, like revenue, profits, assets, etc. But from that point on, its stock price is almost entirely driven by how much demand exists for its stock. But how do you quantify demand? Think about it. Demand is nothing but how many people want to own some stock, or how much money they are willing to pay for it. In market speak, you want to see how many orders people are placing for it and at what price. Modern markets keep an electronic record of all orders that have been submitted. People who want to buy a stock can specify how much or the limit that they're willing to pay for it. People who want to sell can specify the least amount, again, the limit they're willing to sell it for. Whenever a suitable match is found between a buyer and a seller, a trade is executed. It's important to understand how orders are matched. Let's say I submit a limit buy order for 2 shares of Netflix at $180 each. Think of this as an offer or commitment to buy. It is also known as placing a bid, where 180 is my bid price. This order gets added to the market's queue where all the different buy orders for Netflix are listed, sorted by price. Someone else submits a limit sell order for 4 shares at $179.90. This is a commitment to sell, and $179.90 is their asking price. Since that is less than the topmost buy order, the one with the highest bid price, a transaction can now take place. If there are enough stocks to fulfill that order, then the next bid could also be fulfilled with that same seller. In this case, the top 2 buy orders are executed and 3 out of the 4 shares offered by the seller are sold. The remaining 1 share can be used to partially fulfill my buy order, and the rest of it can be satisfied by the next seller who offers a suitable price. Say someone else offers to sell 3 shares at $179.80. This order rises to the top of the sell queue due to its low price, and since this is less than my bid price, my remaining 1 share can come from this seller. So, in the end, with my limit order of buying 2 Netflix shares at $180, I got 1 share at $179.90 and 1 at $179.80 for an average price of $179.85 per share. This sounds a lot like an auction, doesn't it? In fact, multiple auctions going on simultaneously, orchestrated by some authority that ensures every buyer and seller gets the best available price for the stock they want to trade. This authority is the stock exchange. One problem with this model is that trading can take a lot of effort if everyone has to participate in an auction each time they want to buy or sell a stock. What if you wanted to purchase some right away? How do you make sure you're getting the best price? Well, if you're at a farmer's market, you might go around asking every vendor, but that's very inefficient. Fortunately, since stock market transactions are carried out electronically, we have better ways of dealing with this. The stock exchange keeps track of the last price at which a stock was traded. This is publicly posted as the current price of the stock. And if you wish to buy or sell shares around that price, you should be able to do that immediately. This is known as placing a market order. But it does introduce one complication. Someone has to be willing to sell or buy that stock on the other end at all times. That's where a market maker comes into the picture. A market maker is a financial firm, usually a brokerage, that continuously offers to buy and sell stocks at publicly advertised prices. For example, the New York Stock Exchange has designated market makers such as Citadel Securities and J. Stryker & Co., who are obligated to make large volumes of shares available for trading. You might think, why would someone want to do that? What if a market maker buys a bunch of shares and then the price starts falling? And that's right, they do take a risk by continuously buying and selling. But they are usually compensated for that risk by commissions and fees that they earn on those trades. They also maintain a small difference between their bid and ask prices for each stock. Say you want to sell some Microsoft shares at market price. A market maker is bidding $74 per stock, which happens to be the best bid price available, so the market executes your order with that market maker. Later, another investor comes in and wants to buy some Microsoft shares at market price. The same market maker may be asking for a slightly higher price to sell, say $74.10. Assuming that's the best price available, they just made 10 cents on each share. That might not seem much, but over the course of a day, a market maker typically trades thousands or millions of shares. That easily adds up. The difference between these prices is known as the bid-ask spread. This is a very important concept to understand in trading and comes into play in other situations as well. Market makers play an important role in keeping a stock market running smoothly. Imagine what would happen without market makers. It would be harder to buy or sell stocks at a consistent price. As people start selling a stock, its price would start falling, and vice versa. Formally, we say that a market maker provides liquidity. Liquidity is the property of a financial asset, like a stock, to be bought or sold without causing sharp changes in its price. For instance, Apple stock sees a lot of day-to-day activity, so we say that it is liquid. If you have a large number of Apple shares and you want to sell them, there's a good chance you will get a consistent and predictable price for them. On the other hand, stocks that are relatively difficult to buy or sell are said to be illiquid. Penny stocks, for example, are typically very thinly traded. Consequently, buying or selling them may be difficult. Liquidity can also vary from market to market. Oh yes, the same stock can be bought or sold in different markets. HSBC is one such stock. It's listed in both New York and Hong Kong. Let's look at how its price changed during a month of trading. Each market maintains its own book of orders, so the same stock can trade at different prices in different markets. The difference is usually small, as you can see, and any big changes permeate across markets pretty quickly. That being said, it's possible to profit from market inefficiencies by simultaneously purchasing and selling an asset in different markets, thereby exploiting the differences in price. This idea is known as arbitrage. Stock exchanges publish a stream of data that includes each individual trade. This is known as tick data. Ticks are an intuitive way to gauge the health of a stock or even an entire market. Are investors happy? Are they making money? Are prices generally rising or falling, etc.? For example, you can compare each stock's latest tick price with its previous price to see if it is going up or down. You can then aggregate this information by comparing the number of stocks on an uptick with the number of stocks on a downtick. These ticks also form the basis for all market data that is available for analysis. Tick data can provide further insight into how a particular stock is behaving and can help you take better intraday decisions. But you're talking about a massive volume of data. Have you ever wondered how busy stock markets are? The New York Stock Exchange carries out billions of trades every day. That's billions with a B. If you want to keep track of all these transactions and use all that data to make trading decisions, that might slow you down. Even if you want to use historical tick data to build statistical models or train a learning algorithm, it might be too much data to process. Consider that over $42 trillion worth of stocks and shares were traded in the US in 2016, a single year. That's more than double the GDP of the entire country. Investors like to focus on pieces of data that are most important. One way to do that is to take the tick data and bucket it into regular intervals of time. It could be minutes, hours, days, months, etc. And then summarize all the trades that happened during each interval using measures that are relevant to you. Let's take a closer look at one of these intervals. Let's say it's a minute. The most common set of measures used in practice are open, high, low, close, or OHLC. Open is the stock price at the beginning of the period. High and low capture its range of movement, and close is where it ends. These measures are often visualized using OHLC bars, which show these four measures for each time interval in a compact form. This gives you a high-level summary that might better represent price movements than looking at raw prices. Here's an OHLC chart that shows a month of price data, bucketed into single days. You can spot days where the intraday prices jumped beyond opening and closing prices, indicating a lot of volatility. If you tried to plot all the individual ticks over this period, it would be hard to identify these patterns. Sometimes these measures are used for very specific purposes. The daily closing price is the one that is quoted most often. It is used by casual traders and investors who are interested in long-term gains. It is also used for accounting purposes. The opening price is where you would expect the first trade of the day to take place, and there might be a gap from last day's closing price because of pre-market trading or trading in other markets. Some trading strategies try to utilize this difference. High-low. The high and low prices capture the movement of the stock. These peaks are easier to remember for humans compared to individual trades or the distribution of prices during that period. Besides the current price of a particular stock, another metric that traders like to keep an eye on is the number of shares that are being traded over a period of time, known as volume, often shown along the bottom of an OHLC chart. The sum of unit price times volume gives you a more accurate measure of the total amount of money moving around. Volume is also important because it can affect how sharply its price might rise or fall. Let's take a look at an example. Acme Inc. is trading at $100 per share. Several investors speculate that Acme is going to launch a new product, and expecting the new product to increase Acme's value significantly, they place large orders to buy a total of 100,000 shares. The action of buying the shares increases the apparent demand for the stock, and consequently, the price jumps to $120 per share. That is, someone actually buys the share at $120. Why does it jump? Because there are more people who want to buy the stock than those who want to sell. So the sellers can charge a premium, and you bet they do. Let's assume that over the next few days, there aren't any announcements and no significant new activity in Acme stock. Some shareholders want to pull out their money and invest in another opportunity they hear about. So the price begins to fall gradually. Noticing this trend, other investors decide to sell the majority of shares they bought so that they can make a profit while the price is still high. As expected, this results in a sharp drop in Acme stock price. It comes down to $90 per share. If you were monitoring the price and volume of Acme stock, you might have noticed the relationship between volume of transactions and price changes. In general, large volumes of buy orders tend to sharply increase a stock price, and large volumes of sell orders make it fall. This is another signal that you can use to decide when to trade a given stock. It is also something to keep in mind if you're a major investor and you trade in large volumes. Some hedge funds, for instance, will spread their transactions over multiple days so that their own actions don't end up affecting the price adversely. Note that the volume of transactions also varies throughout any trading day. This is something to be aware of if you want to use volume as a trading signal. Stocks that are of active interest will typically see a lot of trading at the beginning of the day, since that is when traders get to act on all the new information gathered and analyzed since the previous day's market close. This initial activity, known as price discovery, helps buyers and sellers converge on a mutually acceptable market price for each stock. Then the volume falls to a lower level as typical daily trading activity resumes. Finally, towards the end of the trading day, activity tends to increase a little, resulting in a higher volume. This can be due to several reasons, including day traders who want to close out any open positions and funds that typically update their holdings at the end of the day. In fact, some traders who have decided to buy-sell particular stocks may not want to risk waiting for the next day. Who knows what events might take place in the meantime and how they might affect prices? Volume carries a lot of information about a stock and is an often overlooked metric. A high volume trade is more likely to affect the price of a stock than a low volume trade. Therefore, volume is an important factor to consider within your trading strategy. Stock markets typically remain open for a finite number of hours every day, say 9:30 a.m. to 4 p.m. This is when the majority of the transactions take place. Why, you ask? Well, traders and exchange operators are humans just like you and me. They need to go back to their families, sleep, and live a life, Okay, there is another reason. With the growing popularity of algorithmic trading, a large portion of transactions today are being carried out by automated systems. They can be much more responsive to market conditions than humans and result in a sharp increase or decrease in stock prices over a very short period of time. If left unchecked, this can result in things spiraling out of control. Closing market operations at a regular time every day provides an artificial barrier that can limit the damage such events can cause. This also gives stock market regulators some time to analyze the situation and implement control measures. Now, some exchanges do allow for pre-market and post-market trading, typically 4 a.m. to 9:30 a.m. for pre-market and 4 p.m. to 8 p.m. post-market. However, not many traders participate in these sessions, so trading volume is typically low. Either way, the takeaway from this is that stock markets close operations at a certain time every day, and they typically remain closed over weekends and holidays. As a result, when you look at stock data, you'll notice these gaps or discontinuities during periods when the markets are closed. Depending on your analysis, this may or may not have an impact on the conclusions you draw. For instance, if you treat market data as a simple sequence of observations and ignore the timestamps, as if the markets just smoothly continue from one end of day to the next opening bell, then these gaps are not as significant. But if you compute a metric that involves time, like the number of transactions per hour, then ignoring these gaps can give you inaccurate results. The discontinuities can produce spikes or unusual flats in calculated values, or just outright wrong information. So, You need to be careful when dealing with market data. Another aspect worth considering is that most major stock markets are actual physical buildings located in a city somewhere on the planet. And because different cities around the globe are at different time zones, the actual opening and closing times also vary. On any given date, the Hong Kong Stock Exchange opens at 9:30 a.m. local time. 7 hours later, the London Stock Exchange opens at 9:30 a.m. their local time, and the New York Stock Exchange opens 5 hours after that. This produces some additional complications and opportunities for traders. For example, consider the stocks that are listed on multiple global exchanges. The price behavior of a stock on the Hong Kong exchange is likely to have an effect on how it performs in London. With a full 7 hours between them, you have plenty of time to decide how you want to trade that day on the London exchange. Imagine the kinds of strategies you can devise. If HSBC rises in Hong Kong, you can buy HSBC in London the moment the market opens, knowing that it is likely to rise there too. Of course, you have to be careful about how you execute such strategies. Remember that if you are trying to take advantage of markets in different time zones, chances are high that other traders are too. Now that you know how stock markets work, how trades are executed, and how prices are set, we'll move on and take a closer look at the data you need to pay attention to. Market data forms the basis for quantitative analysis and trading. In addition, there are several other sources of information that you also need to take into account, such as corporate actions, data derived from fundamental information, etc. All of these affect stock prices, so you need to factor them in when designing your quantitative trading pipeline.
Let's start with market data. This is any data that you receive from the market, typically generated from trades. This is perhaps the most important form of data relevant to quantitative analysis. Market data is temporal in nature. It's a series of trading events that happen in a moment of time. Each moment is called a tick. A tick contains the time of the event, information about which stock or ticker symbol was traded, trade data, and quote data. The trade data is the price and the amount of the transaction. The quote data is the price and size of the bid and ask. A bid is a request to buy stock at a price for a set amount of shares. A ask is the other side of the trade. It's the request to sell stock at a price for a set amount of shares. In large marketplaces, the number of trades can easily hit 200 trades per second. This is a massive amount of data when using historical tick data. Analyzing individual ticks may not be feasible with this much data. So we bucket these ticks into equally spaced time intervals, such as minutes or days. For each bucket, we can compute open, high, low, close prices and total volume of transactions. This sort of minute or day level data is much easier to work with. You have the ability to ignore the timestamps and treat the data as equally spaced sequences. In some cases, you may still need to use the timestamps, but we'll save that for another lesson. In the next video, you'll learn about another type of finance data called corporate actions. For this lesson, we'll describe only two of the many corporate actions: stock splits and dividends. Let's start with stock splits. On June 2nd of 1998, you could buy a share of Amazon for about $85. On this date, Amazon decided to perform a 2-to-1 stock split. Every Amazon shareholder had their shares doubled. This does not mean all of their money in Amazon doubled. When a stock is split into two, its price drops by half. This makes sure that the total market capitalization of a stock has not changed by a split. Market capitalization is the dollar value of a company's outstanding shares. This is calculated by multiplying the stock price by the total number of shares outstanding. In this case, there are twice as many outstanding shares. To keep the market capitalization the same, the stock price has to drop by half. Why would you ever want to split a stock? One reason could be to make the stock more liquid. Less expensive stocks are believed to be more liquid. Current shareholders and potential investors can now buy and sell in more granularity. This helps maintain a healthy volume of transactions. Amazon later went on to have 2 more stock splits. A 3-to-1 split on January 5th of 1999, a 2-to-1 split on September 2nd of the same year. The price dropped to roughly 1/3 and 1/2 respectively. I say roughly because there is still some trading during the day. The closing price ends up being a little different from exactly 1/3 or 1/2. Typically a little higher due to the renewed interest in the stock. If you look at the graph of the stock prices at that time, you'll notice that the large drops are due to the stock splits. Looking at this graph makes it look like the company dropped in value. Using these prices, a computer would read the data the same way. However, this is not true. The value of the company has not changed from the split. How do you correct for this? One common approach is to normalize the prices to reduce the sudden changes. For instance, you could double the stock price after each 2-to-1 split, triple after each 3-to-1 split, and so on. The trouble with that is, your current normalized price will be very different from what the stock is actually trading at. Instead, we'll do the opposite. We'll halve the price before each 2-to-1 split, turn it into thirds before any 3-to-1 split, and so on. Now, the newest adjusted price matches the price currently on the market. Stock prices normalized in this manner is called adjusted price. This is typically provided in most historical data sets. Needless to say, you must keep in mind that this is a distortion of reality. In June of 1998, before the first split, Amazon was not trading at $7. It was trading around $85. It is the repeated adjustments to historical prices that have reduced the $85 to $7. With this in mind, let's learn about the next corporate action, dividend. The next corporate action we'll talk about is dividend, specifically cash dividends. Dividends are when companies share some fraction of their profits with their shareholders. Let's take a look at Qualcomm, which pays out dividends pretty much every quarter. On May 21st of 2017, they paid out 57 cents per share. However, dividends aren't given to everyone that holds shares in the stock at the time of the payout. A shareholder must have bought the share before the ex-dividend date. An ex-dividend date is the cutoff point to receive the future dividends. Let's take a look at an ex-dividend date for AIG. AIG had announced on February 8th, 2018 that they will be giving out dividends in the future. The date the dividends will be given out is March 29th, 2018. The ex-dividend date is March 14th, 2018. Whoever held the stock before this date will receive the dividend. With the basics of dividends out of the way, let's go over adjusting the prices to dividends. We'll start with why we adjust the prices based on dividends. Imagine that you own 1 share of company A and 1 share of company B. Both are worth $50. The next day is an ex-dividend day of $1 in dividends for company A. That day, company A closes at $49.50. Company B does not have an ex-dividend date, but also closes at $49.50. If you only looked at the prices, you might think you lost 50 cents on both stocks. In reality, you made 50 cents on company A and lost 50 cents on company B. Just like the stock splits, we'll normalize the prices to reflect this. To get the normalized prices, we first need to calculate the adjusted price factor. The formula for this is 1 plus D over S. D is the dividend, S is the stock price at ex-dividend date. To normalize the price, you would divide the historical price by the adjusted price factor up until the day before the ex-dividend date. With the knowledge you just learned, let's dive into technical indicators. So, you have your stock prices adjusted for corporate actions, like splits and dividends. How do you use this information to perform trading? When do you buy? When do you sell? Or even which stocks do you buy or sell? You can take these decisions based on signals that can be derived from historical price data. The first step in this process is to compute statistical measures that are called indicators. You can think of the raw price of a stock as the most basic kind of indicator. Here are the stock prices for Facebook over a 1-year period. The latest price is about $115. Is that good? Should we buy some Facebook shares? Well, it's not clear. The price seems to be jumping around a lot, and we don't have a sense of where we should expect to be. If we had that, then we could check if the current price is significantly higher or lower than the expected price and make a decision based on that. So, what is the expected price of a stock? Is it the average price from when it began trading? That seems a little too extreme. Stocks can grow in orders of magnitude over the years. Most current prices will be well over the average. What might be relevant is the recent average price of the stock. Maybe over the past week or month. We can extend this idea throughout the history of the stock and compute the average of a fixed length window of time. It's like moving the window 1 unit at a time and taking the average price within that window. This is known as the simple moving average or rolling mean. We could devise a trading strategy that looks for large deviations from the moving average and generate trading signals based on that. For instance, if a stock falls too far below its average, then we should buy it. Or if it rises too far above, then we should sell. But how much is too much? Using a constant number or threshold does not seem like a good idea. Different stocks trade at different price levels. We need a measure that is tied to the price of the stock. Maybe some fraction of the stock price, but again, what fraction? We don't know. Some stocks jump around a lot, some are more stable. A better idea might be to compute the threshold from the jumpiness or volatility of the stock. How about standard deviation? In fact, we can reuse the windowing idea and compute standard deviation over the same fixed length window across time. These lines are called Bollinger Bands. All these peaks sticking above the upper band are signaling that the stock is trading at a higher price than normal. The dips below the lower band are signaling abnormally low price. One problem that you might notice is that there is too many such points. We can reduce them by increasing the width of the bands, that is, by considering a wider range of variation to be normal. A common threshold is to choose 2 standard deviations above and below. Now we have far fewer outliers. But the question remains, what do we do with these outlying points? Sometimes we get short bursts of outliers. So, should we buy or sell each of these points? If you think about it, when the price falls below the lower band, you don't really know if it's going to keep falling. Or is it going to rise back up? Maybe it's wiser to focus on these inflection points. When the price is below the lower band and starts to cross back inside towards the mean, that should be a good time to buy. The price is still fairly low and on a rise. On the other side, we can sell when the price crosses down the upper band to the inside. This gives us a series of buy and sell signals. At this point, you must be wondering, how much money would I make from following these signals? Well, that opens up a whole can of worms. We'll have to decide how much money to invest to account for the brokerage charges and for a few other things. Let's just kick this can down the road, and we will look at it again when we talk about backtesting. For now, think about the indicators we just computed, simple moving average, and standard deviation, and the trading signals we derived from them. This was a fairly simple approach. See if you can compute other indicators and better signals from the price and volume data. Facebook traded over the month of May in 2017. As you can see, there's these clumps of 5 samples and then a gap, and then another clump, and so on. Take a look at the calendar. For that month, each clump of 5 dates in the plot corresponds to a work week. These gaps are simply weekends when the market was closed. 2 months later, it's July, and we see a similar pattern, but here at the beginning, there seems to be a date missing. It's 4th of July, a holiday in the United States, so gaps in the data can result from weekends, holidays, and other reasons the market might be closed. You might be thinking, why is this important? After all, if we forget about these missing days, the data is still continuous in terms of trading days. Well, that's true if you treat the price data as simple sequence and ignore the timestamps. Then you don't need to worry about the gaps. Say you're computing daily returns. You take the price on each day and subtract it from the price on the previous day. Well, previous trading day, that is. For a more robust approach to trading, you may not want to ignore the missing days, even if the market is closed. Other events can occur that might influence stock prices when the market reopens. For example, company announcements, news articles, geopolitical events, natural disasters, anything and everything can affect the stock price. The more time between 2 trading days, the bigger the window for things to happen. So you could try to normalize returns by dividing the actual number of days between any 2 samples. This may work in certain applications, but can reduce the genuine large differences. Or you could just use that information about these irregular gaps between samples when trying to make trading decisions.
So far, you've seen some stock market data and learned about some of the market processes that generate these data. So you're beginning to see what these long streams of numbers actually mean. As is true of all types of data, stock data represent measurements of things in the real world that have certain properties, and people often take particular steps or make certain assumptions when analyzing them. In this lesson, we're going to talk about some of the important properties of stock data that lead people to analyze them in certain ways. Say we're looking at a time series of prices for a stock. The ups and downs are kind of interesting if we're vaguely curious about how the company is doing. One is the simple difference in price, P sub t minus P sub t minus 1. This might represent the difference between the price of a stock this month and its price 1 month ago, for example. Another is the return, percentage return, or raw return. This is the difference divided by the starting price, P sub t minus P sub t minus 1 divided by P sub t minus 1. $1,000 of stock 1 month ago and sold it this month for $1,050. Your return on your initial investment, $50, is 5% of your original investment. If you buy $5,000 of stock this month and sell it for $5,300 next month, you might want to compare the success of this new investment to the previous one. Instead of comparing $300 to $50, you can calculate the return and compare 6% to 5% to see that as a proportion of your original investment, you did slightly better with the second investment. That's the advantage of using returns. Prices are normalized and thus similar in scale. This is actually a requirement for many statistical and machine learning techniques. Remember how the return was defined as P sub t minus P sub t minus 1 divided by P sub t minus 1? Well, the log return is defined slightly differently as the natural logarithm of P sub t divided by P sub t minus 1. To see how to convert between these two quantities, note that if we add 1 to P sub t minus P sub t minus 1 divided by P sub t minus 1, we can convert 1 to P sub t minus 1 divided by P sub t minus 1, and the expression simplifies to P sub t divided by P sub t minus 1. So if we denote the log return as capital R and the raw return as little r, then capital R equals the log of little r plus 1, and little r equals e to the capital R minus 1. Why do quantitative analysts use log returns? Look at the graph of the natural log of x plus 1. It goes through the point 0, 0, and it has a slope of 1 there. So at 0, 0, it's tangent to the line y equals x. If we were to zoom into a tiny neighborhood around x equals 0, The two lines practically overlie each other, so the natural log of x plus 1 approximately equals x. That's all that equation is saying. How a series of daily price values arises. It has to do with our earlier discussion of compounding. Let's say a stock starts at p sub 0, and each day the price changes by some small percent, the return. We saw earlier how the price at time t could be written as a product of all of these 1 plus little r sub I terms. If we take the log of both sides of this equation, we get log of p sub t on one side and a sum of log of 1 plus little r sub I terms on the other side. Here, for convenience, I'm going to move log of p sub 0 back to the left-hand side. Remember, p sub 0 is a constant, it's not dependent on time. Now, we're going to use the central limit theorem. You might remember the central limit theorem from a class on probability, but if you don't, I'll just explain it briefly here. It says that the sum of random variables that have the same distribution and are not dependent on each other approaches a normal distribution in the limit that the number of random variables in the sum goes to infinity. So let's make the assumption that the returns on each day are independent but come from the same underlying distribution. This seems reasonable, certainly more reasonable for returns than for prices. After all, the price of a stock on one day almost certainly depends on its price the day before. So if we make that assumption, we can see that the right-hand side, the whole sum, is a random variable that follows a normal distribution. So we have that log of p sub t minus log of p sub 0 is distributed normally. But if p sub 0 is a constant, then log of p sub t is also distributed normally, because a normally distributed random variable minus a constant is still normally distributed. Now I'm going to tell you about a new distribution called the log normal distribution. Guess what? It looks kind of like that right-skewed distribution we talked about earlier. What you need to know about the log normal distribution is that if y is distributed normally, then e to the y is distributed log normally. I'll say that again. If y is distributed normally, then e to the y is distributed log normally.